Welcome to Accounting for SS1 at LightTech Academy. Today we study depreciation, the straight line method. What is depreciation? Depreciation is the reduction in the value of a fixed asset over time due to use, wear and tear, passage of time, obsolescence, becoming out of date due to technology changes, depletion, for natural resources, and inadequacy, an asset no longer meets the needs of the growing business. Fixed assets that are depreciated. Motor vehicles, machinery, equipment, furniture and fittings, buildings, but not land. Land does not depreciate under the going concern concept. Intangible assets, goodwill, patents, are also written down, though this is called amortization. Why charge depreciation? 1. To show the asset at its realistic value in the balance sheet, not at its original cost throughout its life. 2. To match the cost of using the asset to the periods in which it helps generate income, ACCIUALS/matching concept. 3. To ensure profits are not overstated. If depreciation is not charged, expenses are understated and profit is too high. 4. To create a fund to eventually replace the asset. Methods of depreciation. 1. Straight line methods, today's topic. 2. Reducing balance method, next lesson. 3. Unit of production method. 4. Revaluation method. 5. Sum of years digits method. The straight line method, a fixed installment method. Under the straight line method, the same fixed amount of depreciation is charged each year throughout the asset's useful life. Formula. Annual depreciation equals cost price, residual/scrap value, divided by estimated useful life, years. Or expressed as a percentage, annual depreciation equals cost price x rate %. Explanation. Cost price, the amount paid to acquire the asset, including delivery and installation cost. Residual value, scrap value/salvage value, the estimated value of the asset at the end of its useful life, what it can be sold for when it is no longer used. Estimated useful life, the number of years the asset is expected to be used by the business. Worked example 1. A motor vehicle is bought for 5 million Nigerian nairas. It has an estimated useful life of 5 years and a residual value of 500,000 Nigerian nairas. Calculate the annual depreciation using the straight line method. Annual depreciation equals 5 million Nigerian nairas to 500,000 Nigerian nairas, divided by 5 equals 4,500,000 Nigerian nairas/5 equals 900,000 Nigerian nairas per year. The vehicle depreciates by 900,000 Nigerian nairas each year for 5 years. Worked example 2. Equipment costs 2,400,000 Nigerian nairas. Residual value equals nil. Useful life equals 4 years. Rate equals 100%/4 years equals 25% per year. Annual depreciation equals 2,400,000 Nigerian nairas x 25% equals 600,000 Nigerian nairas per year. Year 1, net book value equals 2,400,000 to 600,000 Nigerian nairas equals 1,800,000 Nigerian nairas. Year 2, net book value equals 1,800,000 to 600,000 Nigerian nairas equals 1,200,000 Nigerian nairas. Year 3, 1,200,000 to 600,000 Nigerian nairas equals 600,000 Nigerian nairas. Year 4, 600,000 to 600,000 Nigerian nairas equals 0 Nigerian nairas, fully depreciated. Accounting entries for depreciation. At the end of each financial year, the depreciation is recorded as follows. Debit, depreciation account, profit and loss account, on expense. Credit, provision for depreciation account, balance sheet, reduces the asset's book value. The asset account itself remains at cost throughout, it is not reduced. Instead, the provision for depreciation account accumulates the depreciation. The provision for depreciation account. This account accumulates all depreciation charged to date. It appears on the balance sheet as a deduction from the asset. Fixed asset at cost, 5 million Nigerian nairas. Less, provision for depreciation, 2,700,000 Nigerian nairas, after 3 years at 900,000 Nigerian nairas per year. Net book value, 2,300,000 Nigerian nairas. Advantages of straight line method. 1. Simple to calculate. 2. Consistent, same amount each year, easy to budget. 3. Suitable for assets that decline evenly in value, e.g. leases, furniture. Disadvantages. 1. Ignores the higher maintenance cost in later years, and older machine cost more to repair. 2. May not reflect the true decline in value, many assets lose more value in early years. Remember, depreciation equals reduction in value of a fixed asset over time equals due to use/wear and tear plus passage of time plus obsolescence/technology changes plus depletion plus inadequacy. Fixed assets depreciated, motor vehicles plus machinery plus equipment plus furniture and fittings plus buildings/not land. Why charge? Show realistic value in balance sheet, match cost to periods generating income/accruals concept, ensure profits not overstated, create fund to replace asset. Straight line method/fixed installment method, same fixed amount of depreciation charged each year. Formula, annual depreciation equals cost price minus residual/scrap value, divided by estimated useful life in years, or annual depreciation equals cost price x rate %. Cost price equals amount paid to acquire asset, residual value/scrap value/salvage value equals estimated value at end of useful life, estimated useful life equals number of years asset expected to be used. Example, motor vehicle 5 million Nigerian nairas cost, 500,000 Nigerian nairas residual value equals 4,500,000 Nigerian nairas/5 years equals 900,000 Nigerian nairas per year. Accounting entries, debit depreciation account/profit and loss account equals expense, credit provision for depreciation account/balance sheet equals reduces asset book value, asset account remains at cost throughout. Provision for depreciation account, accumulates all depreciation charged to date, balance sheet, fixed asset at cost less provision for depreciation equals net book value. Advantages, simple to calculate, consistent/same amount each year, suitable for assets declining evenly in value/leases plus furniture. Disadvantages, ignores higher maintenance cost in later years, may not reflect true decline in value. Thank you and keep excelling at Lightech Academy, powered by Lightech Solutions Limited.